Macquarie Group posted the best half-year result in its history on Friday, and the market sold it off anyway. The investment bank reported full-year net profit after tax of $4.85 billion for FY 2026, a 30% jump on the prior year. The second half alone delivered $3.19 billion, a 93% surge on the first half, and a record for any six-month period in the firm's existence. Every operating group contributed. The loan book surged 28%. CEO Shamara Wickramaniyake called it a strong and broad-based result. By any earnings scorecard, this was a beat. By 1 p.m. Friday, Macquarie shares, ASX MQG, were down 2.2% to $236.45. That divergence is the story of the Australian session on May 8th. The S&P ASX 200 dropped 1.7% across the day, its sharpest single-session fall in 7 weeks, as fresh reports of U.S. missile strikes near Bandar Abbas and further exchanges inside the Strait of Hormuz sent Brent crude back above US $100 a barrel. WTI swung between US 90 and US 95 in what one market commentator described as oil prices moving like a shopping cart with a busted wheel. The Iran conflict, which had shown signs of cooling earlier in the week, reignited, and the market repriced everything with it. Westpac, NAB, and QBE Insurance each fell more than 1.5%. The Big Four banks, which had looked like recovery candidates after this week's rate pause from the Reserve Bank, reversed sharply. The RBA's decision to hold the cash rate at 4.35% for June, flagged by Westpac's chief economist Lucy Ellis as a new base case, had briefly lifted sentiment. It did not survive the afternoon. Here is the tension the Macquarie result leaves unresolved. If a 93% half-on-half profit jump cannot hold a share price on the day it is announced, what precisely is the market pricing that earnings cannot offset? The mechanism behind Friday's price action runs through a specific channel that sits outside the earnings model entirely. When oil breaches US 100 and the cause is active military conflict rather than supply disruption, institutional investors do not recalculate Macquarie's discounted cash flow. They adjust the risk premium on the whole market. The discount rate rises. Every future cash flow, Macquarie's included, is worth less in present value terms, regardless of how many billions the firm just printed. ASIC's warning this week added a second layer. The regulator issued an open letter on Friday flagging that AI-driven mortgage fraud is accelerating, with frontier models lowering the barrier to sophisticated cyber activity across Australia's lending system. For a firm like Macquarie that disclosed a 28% surge in its loan book through the third-party mortgage channel, the timing of that warning is not incidental. It introduces a risk variable that the FY 26 results, which closed in March, cannot speak to. The countersignal, however, is worth noting. Block ASX XYZ rose 5% on the same day to $103.33 after reporting U.S. quarterly gross profit of $2.91 billion, up 27% year-over-year. Cash App gross profit alone jumped 38%. The market bought Block and sold Macquarie on identical logic. Strong results, different exposure profiles. Block's revenue is US dollar denominated, and its growth engine is consumer payments, not rate-sensitive lending. In a session where the rate outlook deteriorated, that distinction mattered. The condition under which Macquarie's logic breaks is straightforward. If the RBA does not pause in June, if the dissenting board vote cited by Westpac's Ellis becomes a majority, the loan book that drove the record second half becomes a liability. A 28% surge in mortgage origination during a period of rising rates is an asset only while defaults remain low. The August and September rate hikes that Westpac is now pricing would test that assumption directly. Macquarie's FY 26 second half record has a historical twin, and the comparison is not flattering. In the first half of 2022, Australia's major financial stocks, CBA, NAB, Westpac, and Macquarie, all reported strong results against a backdrop of rising rates and geopolitical tension stemming from the Ukraine invasion. In each case, the market initially rewarded the earnings, then spent the following 2 quarters discounting the forward rate path. Macquarie peaked in April 2022 at around $220 and fell below $160 by September, even as underlying earnings remained solid. The mechanism then was the same as today. The market was not pricing trailing earnings. It was pricing the cost of money 12 months forward. The verification benchmark for this cycle is the RBA's June meeting. Westpac has revised its call. The base case is now a pause, not another hike. If that holds, the discount rate pressure on Macquarie lifts, and the FY 26 record becomes the floor for a re-rating. The stock would need to close and hold above its Thursday all-time high of approximately $241 to confirm that buyers are treating Friday's sell-off as noise rather than signal. If Brent crude remains above US 100 into next week and the US-Iran exchange escalates beyond the Strait of Hormuz, that scenario closes. The RBA's stated position that recent hikes were preemptive and that space now exists to assess was conditional on the inflation outlook stabilizing. An oil shock above US 100 sustained for more than a fortnight is historically an inflation shock. The RBA's own language on the June decision would shift. The lean on balance is that Friday's move is an overreaction to macro noise applied uniformly to a stock whose earnings do not warrant uniform treatment. But that lean flips the moment Brent holds above US 100 through the weekend. The number to watch Monday morning is not Macquarie's share price, it is the oil print at the open. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.